Hey guys, Outhenticfx here. Today's lesson is going to be on mitigation and why mitigation occurs in the market. So let's get into it. Right, so obviously this is a chart on gold 1 hour. Basically, where we're going to start is over here on the left side. We can clearly see that price is creating those lower lows and lower highs, right? We have price in a bearish structure right now. Here's a clean example of imbalance, right? Playing out on supply. We have that nice, beautiful bearish order block being formed there. We have a nice clean down candle, which left no buying pressure, but only selling pressure to come into the market. We then see price breaking structure to the left, right? BOS bottom. And then what do the banks do, guys? The banks will bring price back all the way up with this move to fill imbalance, right, in this area. And then from there, let the retail traders get in, see how they react to the market at that current point, and then bring price back up to the supply zone to continue price in the given direction that they want price to go in, right? So now, what is mitigation, right? When we say that, okay, cool, prices came into our supply zone and fully mitigated this order block. What is mitigation? Mitigation occurs when central banks close current running positions. Usually they will return price back to an order block to collect their orders or either close out and then stack more orders, guys. So usually what the banks do, the banks can buy and sell at the same time, guys. So they can literally sell this market all the way down till here, right? And then once price gets to this level, they can always buy price back up to the current positions, right? To either add more positions at this area, stack up more positions, or eventually close out their trades, right? So as you can see, we have a nice clean down move to the downside. The banks brought price back up to their order block. All these big bodied candles is banks pushing price up, right? So here we have a 1 hour chart of, bullish structure being formed and how the banks are bringing price down to mitigate this entire move. I am going to explain this move in a few. So to get back to what I have written here, hence why we usually see price reverse from order blocks. Price will get manipulated, which you can see here. Obviously, they're letting the retail traders get in the market at these areas and then kick them out in this move, right? Price will get manipulated in order to close their positions before reversing price, as you can see here. Hence why it's so important for us to stick to, our rules and trade supply and demand. So to get into the example of what is mitigation, I can clearly show you this example to the right side here. We have clear equal lows being formed, right? The banks do not always need to take out equal lows before moving up, right? So we have that lower low, we have that lower high, lower low, lower high, which is this current price here. And then from there, you can see price got stuck in this trading range. From there, pushed down into this range. Then from this point, broke structure, right? So now this becomes our current lower low, lower high, lower low. And then from there, we then see now price creating these equal lows, right? So once these equal lows have been formed, we do expect price to take out the lows first before pushing up. But clearly the banks had other intentions in mind to drive price up. So we cannot say that this is a break of structure over here because this is our current lower high, right? We need price to break this lower high first, and then from there we can consider that a break of structure. So our break of structure occurs only here. We see that big momentous push to the upside, breaking structure to the left. That's why we have that marked up. So once we print our demand zone over here, right, I'm going to put this in blue so it shows a bit better. Once we have our demand zone created over here and that break of structure to the left, we see the banks buy price and then bring price back down quickly, right? That's for them to balance, to rebalance any imbalance that was left within these candles, and also to, either add more positions or close out positions to then drive price up again, right? So once price gets driven up again, what do we have now? We have a higher high being formed, higher low, and we have another break of structure to the upside, right? From that second break of structure, we then have price now creating a new order block over here, right? This is a bit tight, but I'm sure you guys can clearly see these candles were the candles that broke structure to the left, large momentous push to the upside, and then price will eventually bring price back down, mitigate this area, and then continue its new direction, guys. We always need to look at the last down candle before the major expansion to the upside, right? So that's the bank's mitigating price at that current area. Once we have that push, we can now see that, okay, cool, price is trending, right, in an uptrend. This is now where retail traders get in the market and start using trend lines and all these fancy patterns to trend off. But all these wicks is manipulation. The banks are always kicking them out at certain areas in the market. Look at this trend line that you see, guys. It's not really as clear as there, but for us, we see it clearly because we understand what supply and demand is, right? So now, since we've created, our higher high, higher low, higher high, higher low, remember market structure, higher high, this now becomes our newfound higher low, and then from there we break structure again. Remember, breaking structure in my terms, guys, usually people say that structure needs to break on the candle. I use the entire candle, including the wick. That's a clean break of structure in my books, because that wick, guys, on the lower time frame is candles, right? Probably like the 1 minute or 5 minute or whatever the case might be. So we have that clean break of structure to the left side, right? And now the question is, where's our order block within this area, right? Is it this zone? Is it this zone? Is it this zone? We stick to our rules, guys. Before this break of structure, it's the last down candle, which is here before the expansion. So this is our expansion, which hence means that our order block is this candle. But we can't really use this candle alone. So we'll take the entire range starting from this bearish candle, right? The low of that candle to the high, the low of the range to the high of that candle, sorry. Bam. We'll use that entire range, right, to identify our order block. And then from there, what do we have? The banks come in, mitigate price fully, and then drive price up, right? Once we drive price up, guys, what did we learn about in the market structure video, guys? We need to break the high to consider the trend still valid. So right now, you can clearly see that price failed to break the high and has not yet broken this low here. So what does that mean, guys? That clearly means that now we have entered a trading range. Trading range. And now that means we need to wait to see a shift in structure, right? Once we see this trading range being formed over here, we now see that this is where the banks are letting retail traders play, right? So we see all this momentum being built up in this range. From there, we need price to break structure. So if price breaks the low, that means structure shifts. If price breaks the high, that means we continue bullish, right? And eventually, what happens? We have this push here. Breaking structure to the left. BOS top. Right? And what does that mean? Price now needs to activate an order block. So usually what you'll see when this happens, right? We need to look for areas of liquidity, right? So we've got liquidity over here. This is a clean area of liquidity from this push to this push here. Liquidity has been formed at this area. Liquidity, we can delete this now because we're out of that trading range. We can see liquidity has been formed along this area here. The banks need to take out that liquidity. So our next order block is over here, obviously, but price will always drive or wick at the low to take out the liquidity of this area. So liquidity swept with that move and then expand. Hence why it's very important. So these areas, guys, are very important to look out for. These are where we trade off. We have that push. Just marking it up quickly. That push. Next push is obviously here within this area. This is when we scalping, guys. For those who want to get into scalping, I will give you guys a video in a few. Those who want to hold long term, I will show you a video in a few on how we do that. But this is just the main concept of supply and demand at these areas, guys. Push that in. Price will always sweep liquidity before moving to the upside. So with this trade, it was a bit tricky. We might have got kicked out at this point due to the wick. We might have gotten kicked out at that point. Yeah, we definitely might have got kicked out on this trade. So yeah, so guys, out of 4 trades, we've won 3. That's basically how the banks mitigate price at these areas. We always need to look out for liquidity. Hence why I say look for those areas of imbalance in the market, because the market will always return to those areas, right? You can see these clean candles that are just pushing up to the upside. That's the banks killing, taking out liquidity and also mitigating price. That's the lesson for today, guys. Ciao.